The consumer is just stretched way too thin right now. I mean, we still have high inflation, especially for the, goods and services that consumers actually care about. I know that the Fed targets core PCE, which excludes food and energy, but that's really what consumers are care about. When you have those big tech names, if they start to sell off, it can drag the whole index down with it. So investors need to be thoughtful and tactical and remain diversified.
I'm joined today by David Busch. He is the co-CIO at Trajan Wealth, a fund that oversees $2 billion in assets under management. David leads a multi-asset investment strategy covering global research and portfolio construction. He brings in over 20 years of experience across equities, fixed income, currencies, derivatives, and alternatives. And we're talking today on the 13th of November, the day of the worst sell-off in over a month in the stock market. So let's talk about that first. David, welcome to the show.
Thank you so much for having me.
Let's start by talking about what's going on today. A bloodbath in the equities markets, actually risk assets overall. Bitcoin is down as well. Stocks, crypto, everything just looks bad. Even gold, not doing great, down 1% on gold futures. Stocks notched the worst day in over a month as tech sell-off intensifies. This has been going on for more than a week now, David. It's kind of started 2 weeks ago, and then it was on and off, and then we've had rebound days, and now today it looks like markets are cracking under pressure again. Ironically, or maybe not ironically, the government reopened, so the shutdown is over as of today, but clearly markets don't care for that good news, so things are back down, where maybe markets are just pricing in, but the government shutdown, they're going to make more bad decisions. Shutdown over, they're going to go back to work and make more bad decisions. I don't know. Why are we seeing this intensifying sell-off today, and just generally speaking, the last month?
Yeah, I think it's a combination of factors. One is that there is a concern that has built up over the valuation, specifically over the Mag 7, the large cap tech stocks and their high PE ratios. I think that's part of it. The other side of the coin is, now that the government's reopening, there's an expectation that we're going to receive a deluge of data that's going to come to investors, everything from inflation and unemployment, which could, impact what the Fed does over the next coming FOMC meetings. And I think that's what's driving a lot of it.
Do you think then there's a bubble bursting right now? That seems to be the theme that everyone's discussing. Is there even a bubble?
Well, it's interesting because I know a lot of people have, sort of looked back to the dot-com bust, which I started my career in January of 2000, so I lived through it. The difference today is that these large cap tech companies are flush with cash, they have positive earnings, and so that's a massive tailwind. I think in the short term, one of the big concerns is the capital expenditures that are going to be required to build out this AI infrastructure. And I think we could see some volatility there. Long term, tech is the wave of the future. And so I think that it's important to keep that in mind. But in terms of a bubble bursting, it's hard to tell if this is a bubble that's actually bursting or if it's a sell-off in a slight correction.
Well, let's just look ahead now, David. Are you expecting more volatility towards the end of the year? If so, why?
Yes, I am. And the main catalyst, I think, is going to be what comes out of the Fed. So the Fed cut interest rates in October. December, is still up in the air. I mean, the Fed is going to remain data dependent. And of course, we don't have the data. And so everybody's trying to piece together, what could the inflation metric be? What could the unemployment number be? But, Jay Powell himself said it's not a foregone conclusion. And so if we just take a step back and we look at all of the valuation models, and this is true across almost all asset classes, is that interest rates drive valuations. And so higher interest rates, mean lower valuations. Lower interest rates means higher valuations. And I think that there's some concern that the Fed may not cut nearly as much as most people would like.
What about the end of QT, quantitative tightening? Some argue that may actually inject more liquidity. It's not exactly QE per se, but it does help with driving up money supply, which may or may not help with equities. What do you think?
Yeah, that's a great point. So with the end of quantitative tightening, in my mind, what I think is that it's going to potentially reduce interest rate volatility, particularly on the longer end of the curve, because keep in mind that when the Fed cuts rates, they're only cutting the overnight Fed funds rate, and then the rest of the curve is really driven by supply and demand. And if the Fed's heavy hand is not necessarily adding to their balance sheet, but they're maintaining and reinvesting back into the Treasury market, that should seek to, that should squash a little bit of that interest rate volatility and be somewhat of a benefit to the economy. But you're right, it is adding more money supply into the economy, which in theory should be beneficial.
2 Fridays ago, banks borrowed the most amount on record so far from the Fed's standing repo facility. That may have just been a one-off, but can we continue monitoring that, David, and see what indicators that may give us?
Yes. So with the standing repo facility, you're right. There, that's the facility that banks can go and borrow from the Fed. The other side of the coin is the reverse repo facility, which is where banks can deposit money at the Fed, and those balances had drained as well. And so what that tells me is that, liquidity was starting to dry up a little bit, and I think that that was one of the big catalysts for the Fed to say, look, we've got to do something here to stabilize, the money supply because it looked like reserves were draining out of the system.
David, you coming from a fixed income background, tell us how credit spreads are behaving now and what they tell us about risk ahead.
Yeah, so right now, what's interesting to me is that investment grade corporate spreads have continued to tighten. Even high yield spreads have tightened. And so what that would indicate from an investor's perspective is that, that investors think that these are good credits to buy and so on. What I'm looking at outside of investment grade corporates and high yield is also in the private credit space, because it seems as though a lot of companies, they went from, high yield to the leveraged loan market, which is where, loans can be traded, to private credit. And the difficulty with private credit is that we don't have optics. But there was a headline today that spreads within private credit are actually widening. And so that may be sort of the canary in the coal mine from a credit perspective. And that's one sector that I've been monitoring pretty closely.
What does that signal, David?
Well, you know, the goal of private credit and the reason businesses will turn to private credit is for speed of execution and customization. The difficulty is that when a bank makes a loan, they have certain covenants that are in place. They file UCC reports, which in banking terms we call it perfecting the collateral, meaning that there's an assignment of that collateral to the loan. In the private credit space, I don't know if that's happening, and there's a lot of loans that are being issued that are called Cov Light, meaning that they're trimming some of the covenants that would typically be required from a bank loan perspective. And so my biggest concern there is that, as they've made these loans that are now, sitting on balance sheets somewhere, that, one, do they have access to the collateral? Two, is it a perfected, stake in that collateral? Or will we see something like what we recently saw with First Brands and Tricolor, where they've rehypothecated the collateral, meaning they've assigned the same collateral to multiple loans? And a couple of banks, regional banks, took a pretty sizable charge in that space. And then, of course, BlackRock. There's been headlines, of a $150 million loss and a $500 million loss, but it's all tied to that private credit space. So, it's difficult because we just, as investors, we don't have optics into what these loans are doing, how they're performing, what their collateral is, and so on.
Is there even an incentive for investors to be chasing yield in the bond market right now, given how well the stock market, particularly the tech stocks, have performed thus far?
I think, with bond yield specifically, what's interesting to me is, these are the highest yields we've seen, over the last 15 years, really starting in about 2023, 2024, yields were high. So for us as an investment advisory firm, what we focus on is using bonds, one, as an income generation, but also two, as an asset that can help dampen volatility. I think the correlation between stocks and bonds, and I haven't checked today because it seems like everything's selling off today, but have been at around zero, meaning that bonds can act as a good diversification tool. And so right now, I think, stay up in credit quality, don't chase yields, and I'm focusing for retail clients in that intermediate part of the curve, call it right around that 3 to 5 year part of the curve.
Yeah, and just to finish off the private credit story here, this comes from Jamie Dimon's comments. This was a couple weeks ago, but basically he was on an earnings call, and then he said, when you see one cockroach, there's probably more. It was the closest thing to a vicious burn you ever hear from a major bank CEO. This is from a Business Insider. So he was reacting to the recent collapses by subprime auto lender Tricolor Holdings and other companies. And shortly after, you saw what happened with the Zions Bank and I think it was Western Alliance, a few others missing earnings. Yeah, there we go. Bad loans disclosed on their books, alleged fraud from some of their clients. Interestingly, the broader market is maybe, I don't know, maybe it is, maybe it isn't factoring these risks into account. So I don't think the markets are pricing in a systemic risk in the regional banking sector just yet. What do you think?
That's correct. I agree with that. I don't think that the market is pricing in systemic risk, and I'm not sure that this will evolve into
Mm-hmm.
systemic risk. Right now, it appears to be idiosyncratic or company specific risk, and I agree with Jamie Dimon in that when you see one, there's probably more, and then the question is who's holding it, and which of those loans are bad. And the difficulty is that we just, as investors, in the public markets, we don't have optics into it. And that's, I think, was one of the most difficult things about the private credit space. You know, we don't have optics, and then two, we don't know the performance of any of these loans, and so it's difficult to gauge. And because it's private credit, most investors, aren't watching this space to see any cracks that may be forming.
Well, we can look at consumer sentiment and what the consumer is doing and see if delinquencies on debt, credit cards, lines of credit, mortgages, and so on are rising. I think, depending on which measurement you're looking at. For example, the St. Louis Fed measure on delinquency rates on credit card loans, that's been flat and stabilizing. But generally, have you looked at how well the consumer in the United States, on average, is performing now, and can we extrapolate using that data how they will perform into the new year?
Yes. So I've been monitoring, data that's published by the Federal Reserve,
Yes.
and what we've seen is that, credit card, auto loan, personal loan delinquencies and defaults have been rising. The consumer is just stretched way too thin right now. I mean, we still have high inflation, especially for the, goods and services that consumers actually care about. I know that the Fed targets core PCE, which excludes food and energy, but that's really what consumers are care about because that's what shows up, in their personal income statement, as they go to the store to buy goods, it's there. And so consumers are stretched really thin, and consumers are roughly, 70% of the US economy. And so when the consumer starts to pull back, we'll see that trickle through, from retailers to, autos to, I mean, just across the economy. And that's a sign and something that I've been watching and monitoring closely as well.
Like you mentioned, there is probably a lower expectation for dovishness from the Fed. Treasury's paired off today on the expectation that the Fed may not be as dovish as anticipated before. What do we do then with this feeling of more volatility into the end of the year? The market is very concentrated, and concentration risk is very real. So when we can expect volatility, we want to diversify or at least stay defensive. Very difficult to do when you're just invested in the index, which is mostly just tech, as you know.
Yes, that's right. And by concentration, when we look at the S&P 500 and the composition, it's a market cap weighted index, meaning that the biggest companies, are higher weighted in that index. And if we zoom out and look at those top 10 companies, I think they, represent roughly 30 to 35% of the index as a whole. And so when you have those big tech names, if they start to sell off, it can drag the whole index down with it. So investors need to be thoughtful and tactical and remain diversified. So large cap tech, I'm a firm believer that tech is the wave of the future, and this AI infrastructure build is going to be hugely beneficial to the US economy. In the near term, I would pair that large cap growth with large cap value, specifically dividend payers, because dividends will provide, steady cash flow that can help dampen volatility. And also, if we look at the historical performance between growth and value should perform better in a sell-off than growth. So that's how we're sort of managing it, pairing growth with value and then adding a layer of fixed income to help soften that volatility.
Can you just give us one example of a large cap growth stock and one example of a large cap value stock, just so we know how to reference this?
Yeah, so large cap growth is specifically the tech names. It's all the Mag 7, the
Okay.
Teslas, the Metas, the Nvidias of the world. Large cap value can be everything from, Citi and JP Morgan to energy producers, utilities, um, you know, uh, construction, manufacturing. Those are sort of the stalwarts, those that have been around and that are cyclically proven businesses that are at reasonable valuations. And by reasonable valuations, I look at, PEs of, right around, call it 15 to 25. Anything below that, you have to be careful that you don't fall into a value trap, meaning that, there's a reason it's discounted and, there's not a lot of earnings growth, but you can kind of balance that out.
This is a chart that's been circulating on social media. Just get your reaction to this. Even next to Nvidia, Tesla's valuations look ludicrous. So this is trailing PE, 320 on Tesla, and then you got 55.6. So yeah, even amongst its peers, it's kind of high. Where do you as a fund manager draw the line? I know you look at peers and you look at comps, but what's high for you? Is there a number?
Yeah. So for me and my personality, and one of the best pieces of advice that I got
Yeah.
in my career in finance is trade your personality, and so
Okay.
as a fixed income, value income oriented, personality, Tesla's PE seems, I mean, especially as you look at its peers, I mean, it's extraordinarily high. The others, if we look down into Meta and Amazon and Microsoft, even, call it Apple down to Alphabet, are they reasonable? Well, if we zero in on like somebody like Apple, right? They have a huge amount of cash sitting on their balance sheet. So they're going to be able to weather a storm. The others, you know, likely seem, pretty well in line with valuations, but Nvidia, it seems a little high at 55 and Tesla seems really high at 320.
Is fixed income a hedge against equities right now? In other words, do you expect the correlation between yields and stocks to diverge?
Yeah, I think that's right. Especially if the Fed, if there's something dramatic that happens in the economy and the Fed steps in, they'll lower interest rates fast. A rule of thumb, and again, this is just a rule of thumb, is the Fed has historically operated with escalator up, elevator down. Because historically, once we're at the neutral rate or above it, if something cracks, they cut rates pretty quickly. So in that scenario, bonds will be valuable and hugely beneficial because yields down, bond values will go up and help offset some of that price risk in a portfolio.
Well, this year was not actually a bad year for the U.S. 10-year. So we had, as you recall, throughout the year, yields stayed relatively well. Let's just take a look here. So yeah, I mean, it wasn't great, it wasn't bad. I mean, it was just range bound all year mostly, and then this was a year when the S&P climbed what 23, 25%, probably a bit less now today. And so you would expect maybe in a year like this for bonds to really underperform, but they didn't really. Why is that?
Yeah, it's so bond yields are a combination of, two components. And let me back that up. Treasury yields is a
Sure.
combination of two components. One is, as an investor, you want to get paid for the time risk or the term risk, but also you want to get paid for the inflation expectations. So as inflation expectations come down, that should be a tailwind and drop, bond yields should start to fall or remain relatively stable. But if for whatever reason we see inflation spike, and it could be to a myriad of factors, we would see bond yields, jump. But also if inflation expectations come down significantly, we'll see bond yields fall. So I think it's really driven by those inflation expectations.
Yeah. So actually, this is the 10-year yield. Start of the year about 4.46, now down to 4.1. So yeah, the 10 years had a pretty good year, and huge volatility around tariffs. How do you think fiscal policy and specifically trade policies with tariffs in other countries, how do they impact the bond market?
Yeah, so tariffs are essentially a tax, and if we think of it like a tax, then we can see the impact on the economy. So initially, tariffs will be inflationary because the cost of the goods that we're shipping from overseas to the U.S. is going to go up. The question is, can they pass that increase in price on to the consumer, or will the consumer pull back? Over the long term, tariffs ultimately become deflationary because of that consumer demand pulling back.
I'm just going to go back to what I said earlier about the correlation between stocks and long-term yields. So there have been times when stocks and the long-term treasury yield are correlated. Early in the year, for example, there have been times when they're not correlated. You can certainly find periods when one is applicable and one isn't. Typically, what does it mean when both the 10-year yield and the stock market move in the same direction, as was the case early in the year? And what does it mean when they completely diverge, as was what happened this summer?
Yeah, so an easy way to think about it is stocks are risk on, bonds are risk off. It meaning that,
Yeah.
if investors are, if the animal spirits are in the market, they'll move into the stock market, which should cause stock prices to go up. When when there's volatility and stock prices start to come down and investors get nervous, then typically, bond yields or bonds will perform well and yields will come down.
Hmm.
Now, you're right. There are times when they are, maybe not one for one correlated, but they move in the same direction. And typically that's when investors are just, fearful of, what can happen in the stock market and the bond market at the same time. And again, the bond market, is probably price movement is likely driven by inflation expectations, specifically in the treasury space.
So right now we're in an environment where the stocks continue to go up to record levels. Well, except today we have a big sell-off today, and then the yield just continues to on a monthly, we're sort on a several month basis. We've got yields coming down. So yields coming down while stocks are going up. One could look at that as saying the stock market is running off on its own and not really correlating with reality here, or maybe the bond market is sniffing out some risk that equities investors are not. How do you interpret this?
Yeah. So again, with a bond background, I'm a fixed income
Sure.
investor
Yeah, there you go.
by heart and by trade. You know, when we look at price action, specifically between stocks and bonds,
Hmm.
um, you know, my interpretation is that everything that the Fed has done over the last couple of years to squash inflation, even though we still have persistent inflation, specifically in the services sector, but those inflation expectations are coming down. Meanwhile, with the animal spirits that have been present in the equity markets, people have still been investing in those names that you pulled up on your chart. Those are all the Mag 7. And so, people don't want to be investors don't want to be left off sides, and not be invested in these big names, especially as we've seen this massive growth. So I think it's just sort of a recalibration and looking between that large cap growth, large cap value, and then adding in that layer of fixed income.
So let's run through some scenarios here. Inflation data cooling and inflation data running hotter. So let's start with hotter first. If indeed we have higher inflation, where should we be leaning to sector-wise?
Yeah, higher inflation would mean that the inflation premium in the treasury market will increase, meaning yields will come up. In that case, with the valuations, stock valuations should come down. So, so a rise in inflation will see a sell-off in the bond market, yields will come up, and a sell-off in the stock market. If inflation cools, then yields should start to compress and it should be supportive of equity valuations. That's why at this point, at this juncture, with where we're at in the cycle, I think it's so important to balance that growth with value because value will, provide a ballast for growth. So inflation running hot, value should, in theory, overperform against growth. And if inflation cools, growth should outperform versus value.
Can you see a scenario in which we have higher inflation and more growth? Does that happen often?
It can, and in that case, it's likely driven by that infrastructure build out that has to happen with this whole AI infrastructure. So, while most investors are focused on the Mag 7, those big large cap tech names, what I've been looking at is going that next level down below and saying, okay, what are the businesses and services that are going to, be required to build out this AI infrastructure? And it goes beyond kind of the chip manufacturers and the big tech names. It goes into everything from like construction, manufacturing, equipment rentals, energy production. That's a big issue in the US is if we want this AI infrastructure built, we have to provide energy to power those data centers. And so those companies should be benefited as well. So I'm looking at, everybody from, natural gas producers to uranium miners to, rare earth minerals and so on, because that could be the big boom to the economy is with this manufacturing and the uplift that's going to be required.
Do you think that the tariffs have any long-term impact on the manufacturing sector in the U.S.? In other words, are you bullish on domestic manufacturing?
I think it's going to be difficult to onshore. A lot of the manufacturing is going to be required in the near term because, I mean, to build these manufacturing plants is going to be extremely difficult. Instead, what I could see is shipping, manufacturing to some of our other partner countries. But that's the lasting legacy of these tariffs is that, now the cost of goods that are being manufactured overseas and come into the US are going to be priced higher. And it's going to, potentially slow down the momentum that's needed to build this AI
Okay.
infrastructure.
Okay. And how do you generally hedge against volatility? Say you're bearish on economic growth or you're expecting some sort of contraction or you're just generally not very confident that valuations can sustain. People take this a number of ways. The common way is to just stay defensive, get on the defensive sector, staples, consumer staples, healthcare, utilities, fixed income. People use other instruments to hedge outright, or they find alternative assets that may have a negative or inverse or just no correlation at all with the stock market. What's your approach?
Yeah, so that's a great question because what can happen, right?
Hmm.
So if an investor thinks, there's going to be increased volatility, there's going to be a market sell-off, I'm going to hedge it. But then, the market continues to reach new highs. So the way that I manage it is again balancing between those three asset classes, growth, value, and fixed income. But one asset class that I've been monitoring closely and that we actually utilize in some of our client portfolios is a managed future strategy, which is a trend following strategy, and it can invest in it can be long or short. And so if the market is going up, it tends to, go up. If the market's going down, it tends to perform well as, on the opposite side. So they they try to make money in either direction. So, and they utilize things like interest rate, commodity, interest rate futures, commodity futures, to try to gauge that. So the nice thing about managed futures is it's an uncorrelated asset class and can be added to a portfolio to dampen that volatility.
Okay, so am I right to interpret this as being it's not a static vehicle, like it change the components of this managed future funds, it changes constantly?
That's right. That's right. Because those, the portfolio managers who are running, these funds, they can go across any different sector. Again, it could be interest rates, it could be commodities, it could be equity futures, and all they're trying to do is just, follow the trend and if the market's moving higher, they want to participate in that. But if the market's moving lower, they're going to put on some instruments and some trades to help, do perform well during those times, during those market sell-offs.
Now that the Trump administration has made it easier for cryptos to be held in 401ks, have you started looking at this asset class?
Yes, yes. It's interesting because I still remember when Bitcoin was, kind of first, evolving.
Hmm.
And but yeah, I think that it's an asset class. Obviously there's ETFs that are comprised of digital currencies, and that's an asset class that we view as speculative. But I think that it's got a place and purpose, and the way that we try to manage that is to limit the downside risk. So some of the funds that we invest in seek to participate in the upside, but limit the downside risk through a series of derivatives. And from that exposure, it makes a ton of sense. But as the volatility on crypto is super high, and most individual investors, can't buy like, even a Bitcoin, one coin at 100,000 or 98, whatever the price is today. So putting it in an ETF type fund, I think makes a ton of sense.
Okay, great. And finally, what can investors expect looking ahead? What are some of the major economic events and or economic milestones that we need to be following?
Yeah, I always go back to the big three, which is the three that the Federal Reserve follows. So it's core inflation, it's unemployment, and it's GDP. So right now, yes, inflation has been falling, but it's been persistently high and persistently above that 2% target. Meanwhile, we've started to see some cracks form in the employment in the labor markets. Now, we didn't get a jobs report, and we won't get a jobs report while the government was shut down.
Hmm.
But, we've seen, layoff announcements. There was also, government employees who were furloughed, and some fired. So, it's likely that the unemployment rate has actually come up, but we just haven't observed it. And then, of course, economic growth. So those are kind of the big three. And then the next steps will be, how does the Fed react? So in December, a rate cut is not a foregone conclusion, but having said that, if the data warrants, they'll cut. But if the data doesn't warrant, because they have this dual mandate of stable prices and maximum employment, and it's going to be difficult for them to thread the needle and orchestrate the quote unquote soft landing between those two, because they're sort of moving in the opposite directions. Inflation is still high, but now have a rising unemployment rate.
Okay, very good. David, very good talk. Thank you very much for your time. Where can we learn about you, follow your work?
Yes, you can find us at trajanwealth.com and across all of our social media platforms.
Okay. We'll put the links down below, so make sure to follow Trajan Wealth down below. Thank you very much, David. Appreciate your time. We'll speak next time.
Thank you.
Thank you for watching. Don't forget to like and subscribe.